regression should be like in the 0.1, something like that.
No, it's like 1 point something.
For the price to book ratio regression?
Yeah, for the U.S. regression.
I'd be very surprised with that big
double check.
double check.
Maybe I
yeah, maybe that, because that sounds like a big effect on price to book.
Yeah.
Okay, might as well get started. A couple of reminders. One is, as soon as you have the numbers ready for your project, not the whole project, right? The DCF, the relative valuation, and your recommendation, buy, sell, or hold, send that Excel spreadsheet to me, the summary spreadsheet. I'll send out another copy in case you say, what spreadsheet? So I'll make sure that you get one today. And if you can send it as a group, great. But if there's one person in the group, or maybe even two are not quite complete, just send me the numbers you already have. And when those two additional people are done, they can send it to me separately, because I'd rather have some of your reports rather than none of them. I mean, the deadline is you can get it to me by tomorrow night, but the earlier you get it, the easier my life becomes, because I can start entering the numbers into that summary spreadsheet. Because as I said, Wednesday's class depends on you. Okay? If you don't have the summaries, the class kind of comes apart at the seams. So I need to get as many summaries as I can. And I'll nag you. You'll get several emails today and tomorrow saying, are you done? Can you send me the numbers now? So just make sure you don't mess with the template that I sent, because I just copy and paste into my so if you add columns or delete columns, it makes life difficult for me. So just as best as you can, try to use today's closing price as your price for the final the final inputs, because that way we'll all be working with the same template. But if you use Friday's closing price, let it be. Wednesday, the project is due by 5 p.m., not in class, but by 5 p.m. But please do come to class, because that class is the one we'll talk about all of the valuations. So this is really not to you, because obviously you are in class. I'm talking to the people who have been watching in virtual reality for I don't know how long. So final point, the final exam is on Friday from 1 to 3. And there will be two rooms. One is 170, not 260, but 170, because they couldn't give me 260. And this, I'll send out the seating assignments for that sometime actually by tomorrow. And I'll put up the final exam review after class today, so you can get started on that. Because I know once the project is done, you've got like less than 48 hours for the final exam. Okay, so any questions before we start? So keep the final report. If you haven't started writing it yet, I don't want to know what to tell you, but there's not that much to write. That's the good news, because you shouldn't be writing a lot of prose. It's really a summary put in a summary, a couple of pages in front, giving me all your recommendations, a summary of all 5 or 6 of your companies, and then it'll be individual companies after that. So if that's the way you've written it, that's fine. So you just have to gather together the numbers, and there'll probably be a holdout person in every group who's not quite done till the very last moment. Deal with them. No, nothing I can do at this point in time. Right? So let's start today's class. We're going to talk about changing values. So far, if you've noticed, for 24 sessions, we've been the outside looking in. From in what perspective? You're investors looking at a company saying, if that company doesn't borrow money, I can't do much about it. If it's taking bad projects, not much I can do about it. Today, we're going to talk about what you would do if you ran the company. And what you're going to see is, for those of you in my corporate finance class, this is the class where corporate finance meets valuation, where all the levers come back in your control. So I'm going to start off today's session with a few tests on value enhancement, changing value. So I'm going to list off some actions. And I want you to think about value. And we've talked 24 sessions about what it is that drives value, cash flows, growth, and risk. And tell me whether these actions would affect the value of your company. A stock split. What does a stock split do? The minute after the stock split, you have a different number of units in the company, right? 100 shares become 200 shares. The cash flows don't change, the growth doesn't change, the risk doesn't change. So stock split should not affect value. How about impairing goodwill? This is a big deal now, right? Companies writing off 2 billion, 5 billion, 7 billion in goodwill. Should that affect value? What's the key question? Impairing goodwill does make your income look worse, right? But does it affect your cash flows? That's really the question. And for it to affect cash flows, what has to happen? I mean, it's a non-cash charge. But if you were given a tax deduction, it would affect your cash flows. But because impairing goodwill does not come with a tax deduction, all it does is make your cosmetic earnings look much worse. It does not affect your cash flows. It does not affect your growth looking forward. Of course, it affected your growth looking back. It was a bad acquisition. And it does not affect risk. So impairing goodwill doesn't. So the big question is, why do we spend so much time and so much money paying accountants to impair goodwill if it doesn't affect? And that's a different question I'll let somebody else deal with, because I've never understood it. Changing depreciation methods. In the US, you're actually allowed to have 2 sets of books. Your reporting books are what you and I see in the 10K and the financial reports, the annual reports. And there's a tax book that they keep for the IRS. So let's assume a company changes just its depreciation method in its reporting books, but not in its tax books. Usually what companies will often do is go from accelerated to straight line depreciation just in their reporting books. Why would they want to do that? What's the benefit of switching to straight line? The amount of depreciation actually decreases for the year in which they make the switch. Your accounting earnings look much better. But if you do it just in your reporting books, it's not affecting your taxes, and therefore it doesn't affect your cash flows, it doesn't affect growth, doesn't affect risk, doesn't affect value. In the late 90s, actually, US companies, many companies which had an online component to them, New York Times Online, DLJ, Investment Bank Online, started issuing what were called tracking stock. These were shares issued against their online units, and they were doing it for one reason and one reason alone, to take advantage of the fact that online stocks were going up in value. But those online divisions were not spun off from the company. They stayed part of the company, they didn't have their own cash flows, no growth. So all you've done is taken the same company and created regular shares and online shares with no corporate governance protection for the online shares. Again, no effect on cash flows, no effect on growth, no effect on risk, doesn't affect value. So none of those actions actually would affect value. But can they affect price? Can a stock split affect price? Yeah, we know it does. Actually, there is evidence that stock splits affect prices. Could impairing goodwill affect prices? Maybe. Maybe investors just freaked out by a $2 billion write-off. Already you can see the contrast we need to draw between value enhancement and price enhancement. 90% of the time when CEOs say, I want to enhance value, you know what they're really saying? I want to enhance prices. Much of the time, what you see as value enhancement in practice is price enhancement. And today we're going to draw that distinction. So the question I'm going to ask you, what did you come to do? Did you come to enhance value in your company? Did you come to enhance prices? Because the kind of advice I would give you would be very different. Now let's assume you're hired as a CEO for a multi-business company. It's in 4 different businesses, 4 divisions. And I'm going to give you the numbers for each of these 4 divisions. I'm going to ask you a question that looks like a slam dunk question, but humor me. So basically, you got 4 divisions, and you got the returns on capital and the cost of capital of each of these divisions. So if I just pause there, if this were a corporate finance class, it's easy, right? One of these divisions is a big-time loser. In this case, Division D, its return on capital is less than the cost of capital. You've now become the CEO of the company, and you're planning to sell one of these 4 divisions. Which one would you sell? I told you it sounds like a slam dunk question. Most of you would say you would sell the worst of the 4, get rid of it, right? But what's the effect of divesting a business on your value? What do I have to compare? I have to compare what that business is worth to me, continuing in my company, and what somebody else will pay for that company to get it off my hands, right? So if I go out there and try to sell my worst business, everybody knows this is an awful business. They're not going to give me back my capital saying, oh, we're going to make you whole again. In fact, I wouldn't be surprised if in trying to sell this business, you actually got less than what you would make as your continuing value because it's such a bad business. This is how Ford got into trouble in selling Jaguar Land Rover, right? Because in 2009, it looked like a bad business. It wanted to get rid of it because we don't want bad businesses in Ford. And Tata Motors came along and said, would you take this? Penny change. And they said, sure, it's a bad business. We'll get rid of it. And they sold it for less than it's worth. In fact, the irony is in multi-business companies, if you want to sell a business, guess which one is most likely to get a divestiture sale value higher than what it's worth to you? Not your worst business, but your best business. It's actually one of the ironies of going into multi-business companies. It's your best businesses that people will overpay for, and you're judged not on whether you got rid of the best business or worst business, but what you got in return for the divestiture. So we're going to talk about divestitures today, and what you're going to notice, it's the flip side of acquisitions. Because how do you create value in acquisitions? You pay less for something than it's worth, right? In divestitures, you divest it if what you receive from what you sell is greater than what you will get by keeping it in your company. Just put a minus in front of each, and you'll see it's exactly the same process. Now let's talk about capital structure, another component that you have control with when you run a company. So a company has $200 million in debt, $800 million in equity. You do the optimal debt ratio, and you come up with an optimal debt ratio of 20%. So it's already at its optimal, right? CFO says, nothing else we can do. Company's already its optimal, capital structure is optimized, let's go look somewhere else. Is that true? Is it true that once you got to the optimal, there's nothing else you can do in capital structure? Think back to your corporate finance class and think of what else you could check for to see if you can bring down my cost of capital. What's the right kind of debt for your company? It's a debt that best matches your assets, right? If you have short-term debt funding long-term assets, dollar debt funding euro assets, your debt ratio might be okay, but you're paying too much as your cost of debt because your default risk is high. For bad reasons, because you've mismatched your debt. You might consider actually matching up your debt better. And maybe by doing that, even though you stay at a 20% debt ratio, your cost of debt could go down. Also, we took the beta as a given. But we said beta comes from how discretionary your product or service is. Maybe there are things you can do as a company to make your product or service less discretionary. I'm not just talking about advertising. That's quasi, you're playing with people's minds. But actually changing the characteristics of your product to make it something that people can't live without. So when you look at debt ratio, don't just stop at the optimal. Also look at what kind of debt. See what else you can move around in capital structure to lower your cost of capital. And finally, let's talk about dividend policy. At the time that I wrote this question, Google had $60 billion in cash. Now it's about $85 billion in cash. Let's assume that Google decides to use $45 billion of that $60 billion in stock buybacks. Actually, Alphabet has announced a whole set of buybacks that are coming. Facebook also has announced buybacks. So what they're doing is taking a big chunk of cash and returning it to stockholders. If you were Google shareholders, are you made better off or worse off by this buyback? What determines whether a buyback increases or decreases value for you? true you're getting cash in your pocket. That's the good news, right? But it's also true that the cash in the company is decreasing by that amount. So what will happen is you'll get more cash in your pocket, the stock price will drop by roughly whatever was returned. Or is that the place where you have to stop it? I mean, when we talked about the value of cash in different companies, when we talk about how much investors valued cash at, what did it depend on? What kind of track record you had as a company, right? If you were a company that was well regarded, your cash was valued at whatever you had, perhaps more than that. If you are a badly regarded company, then people punished you for the cash. So what's the question I'm asking about Google? Do investors trust Google with the cash? And the answer is yes. This will be a pretty neutral transaction. You see why? Because you're not being punished for holding the cash. Returning the cash is going to make some people happy, some people not, because you now have to pay, you got fewer shares outstanding, whatever. But the net effect of this buyback will be close to zero for Google. As opposed to whom? As opposed to Hewlett-Packard saying we're going to do a $10 billion buyback. My guess is there you're going to see a jump in the stock price, not because of the buyback per se, even though that's pointed to as a reason, but because Hewlett-Packard was a kind of company where they were probably being punished for holding cash. So we're going to look at the layers, and you can see nuance in this approach where you can't just look at the action itself and say that's good, that's bad. You have to look at the consequences and work them through. So let's get back to the notes, because there are a few very, very quick loose ends I want to hit in acquisitions. And I'm not going to go into these in detail because I actually have, and some of you might have already watched the YouTube video. But I want to take you through the template of how I approach acquisitions, and you can pick up, develop your own approach. So I'm going to use the InBev SABMiller merger as my example to illustrate this process. So here's what happened. AB InBev, which was the largest brewery in the world, was buying the second largest brewer in the world, and the revenues of InBev were 46 and SABMiller was 22. So at the time of the merger, I saw the news story, and the first thing I did was I drew the picture of what these two companies were and what they did. What made this merger interesting was even though these two players were the first and the second largest brewers in the world, they actually had very interesting geographies where AB InBev dominated in parts of the world where SABMiller was weak, and SABMiller dominated in parts of the world, like South Africa, where AB InBev had very little of a footprint. So there's global complementarity, which they pointed to as potential benefit. And they also talked about cost cutting. Now, every company talks about cost cutting. Usually you're skeptical. But InBev has a reputation of doing this very well. In fact, they bought a Mexican brewer called Grupo Modelo. But they bought the company, and they managed to cut costs by 30% of the company. They took the company from having one of the lowest margins in the brewery business to one of the highest margins. So there's some credibility they bring to the table. Now, as part of this merger, there are going to be some consequences because you got antitrust factors kicking in, right? In some parts of the world, they're going to become almost monopolies. So if the merger goes through, they will have to sell their stake in Miller Coors because they owned 49% or 41%, 45% of Miller Coors. They would have been forced to sell that because it had become too big in the US. And second, they'd have to sell the Chinese segment of SAB because, again, antitrust rules would have kicked in. So that's what the merger looked like on the face of it. Looking at the companies themselves, you can see the geographic breakdown. They're both global brewers. And if you look at the margins, InBev has operating margins of about 32% and an after-tax return on capital of 12%. It's a very aggressive company in terms of growing. It reinvests a lot. So this is InBev standing alone before the merger. So you can do this with any acquirer, any target. Look at the company before the merger. Look what it brings to the table. Now, if you look at SABMiller, also a global company, but margins which are lower, 20% margins as opposed to 32% margins, at 10.32% return on capital as opposed to a 12% return on capital, and a reinvestment rate of 16% rather than 50%. So if I told you the stories of these two companies before the merger, I would describe InBev as a very aggressive company, growing fast, reinvesting a lot while maintaining high margins. And SABMiller is a very conservative company that doesn't reinvest very much, doesn't grow very much, and has lower margins than SABMiller, than AB InBev. So those are the two companies. And here's what the merger looked like. SABMiller's market cap was $75 billion before the merger. And the deal was actually completed a month later, at $104 billion. So InBev is paying a $29 billion premium. That's a pretty hefty premium. The big question in this merger is, Was that premium justified? Now, one thing that again tilted me when I looked at this merger was InBev is run by 3G, this Brazilian private equity group that has a history of being very shrewd. They're not people who just throw money around. So that's in the back of my mind. It's 3G running this. They're probably not going to do something stupid, but I still have to look at the numbers. So here's the process I approach. There are broadly three potential reasons you could do an acquisition. One is you might find an undervalued company and take it over. So this has nothing to do with synergy. This is more on the question of you're acting like an investor. It could be undervaluation. The second is it could be control. Maybe the target company is so badly run and badly managed that you think you can run it differently. So as I go through these reasons, I want you to think about, is that the reason I'm taking over SABMiller? And finally, it could be synergy. And that synergy can take the form of either growth synergies or cost of capital, but basically all the synergies we talked about. So here's my template whenever I look at a merger. I start with the acquisition price, which I know by the time, so $104 billion. I do a status quo valuation of the target company. You know what I mean by status quo? Basically, I take the company, I forget about the fact there's a merger, I value it as is with its existing management in place. Then I look at the restructured value. Basically, I take the same target company and say, if somebody else ran the company, would I get a different value? And finally, I talk about synergy. Don't even look at synergy until you've done those first three. Acquisition price, you got the status quo value, restructured value, and the synergy value. If undervaluation is your motive for this entire acquisition, the price you pay for the target company has to be less than the status quo value. You're not buying it for control, you're not buying it for synergy. You're just buying it because you found a cheap company. If control is your reason for the merger, the price you pay for the target company has to be less than the restructured value, not necessarily the status quo value because you plan to fix the company. And if synergy is your reason for the acquisition, the price for the target company has to be less than the restructured value plus the synergy value. So already you can see to do this in this acquisition, I've got to estimate start with the status quo value of SABMiller. Then I'm going to move on to the restructured value, and then I'm going to bring in synergy. So let's start with the status quo value. I took SABMiller as is, and they have this big Coors joint venture which I have to consider. And the value that I got for the company as is with the Coors holding is $51.5 billion. Status quo value is $51.5 billion. What is the market price before I even did this? $75 billion. So already I can tell you that you're not buying SABMiller because it's undervalued. That doesn't, I mean, I might be wrong about my assumptions, but it's really not going to be worth $120 billion. Then I look for the potential for control. I compared the two companies, and clearly you can see, looking at them, clearly InBev is much higher margins. But InBev might be the outlier here. I can't assume that every company can be like InBev. So I looked at the global alcoholic industry average, and it is pretty close in terms of margins. Higher tax rate, lower return on capital. So basically it's a mixed bag. It's not an obviously badly managed company. So there are tweaks you can do. Maybe you can be a little more aggressive about the way you grow. So I valued SABMiller with just changes put into it. And the changes are relatively mild. This is not an incredibly badly run company. But with the changes put in, the value that I got as my additional value, actually the value that I got with the restructuring was about $56.2 billion. The value of control here is about $4.7 billion. It's not huge because it's a fairly well-run company. It's conservative, but it's not badly run. And we pause right there. If InBev said the reason for this acquisition was control, I can now make that judgment too, right? Because with the control, the company's worth $56.2 billion. It's still less than the $75 billion. So we're left with only one possible explanation you can go to, which is it's synergy. So that's what I did as my last step, is I took the two companies and I created a combined company with no synergy. And it's actually a little messier than it looks because you have two companies with different sizes. You can't just average numbers out. But here's my combined company status quo. Return on capital will be about 11.68%, growth rate of about 5.09%. Now remember, this is going to be a huge company. I can't make growth go to 10% or 15%. The growth I put in was about a 1% increase, which is again big given the size of the company. A smaller increase in the return on capital, and a slight increase in margin. That slight increase in margin of 1.73% translates into a cost cut of about $1.2 billion on a continuing basis. So it's pretty substantial synergy. And what I got as my value for synergy was about $14.6 billion. So let me pause right there. My status quo value is $51.5 billion. My value of control was $4.7 billion. My value of synergy is $14.6 billion. You add those all up, the value you get as a combined value is about $71 billion. And InBev was paying $104 billion. Now, of course, there are places to assume, so you can go back and say maybe the status quo value is too low. But this is a merger that you're pushing at the very limits of what you can get away with. So notwithstanding the reputation that 3G brought to the table, I think they paid too much. They might have other plans to control the food processing business and other businesses and bring them all under one umbrella. But they paid too much on this merger. But time will tell, because the merger is still working its way through. That was approved, but now they're having to start to sell off pieces because of the antitrust laws. Let's see how it works out. But the template here is the template you would use whether you were looking at Tesla Solar City or at any other merger. Start with the status quo value, do a restructured value, then bring in the value of synergy, and keep the acquisition price always in sight, because you can tell then whether this price is too high or too low. Any questions on M&A in general? So now let's talk about value enhancement. I'm going to start with this divide between value and price enhancement by bringing to your attention two studies from way back in time. The first study was done in the late 1990s. It's called a Rose by Any Other Name. And what it did was it looked at 62 companies that changed their names. You're saying, big deal, companies change their names all the time. What these companies did was something very specific. They added .com to their names and changed nothing about their businesses. So all you did was you put, at the end of the day, as you left the offices, you just painted .com at the end of our names, and the company is going to stay as it is. Now, this is an easy one, right? If I ask you what the value of this company is post-name change, if all you've done is added .com and changed nothing about the way you do business, your value shouldn't change, right? But in the day that they announce this change, their stock prices jump. By how much? Many of these were small companies. So I want you to keep this in mind. They jumped on average 150%. Why would they do that? These were the late 90s. This is a .com boom. You added .com to your name. You say, why are we wasting our time on cash flows, growth, and risk? This seems like a much easier way to go, right? The only problem is, look at the second graph here. This was from a study 4 years later. So remember, by now the .com boom is busted. This study also looked at companies that changed their names. You know what they did? They took .com out of their names. And the market said, this is amazing. This is great. And the stock price jumped again. This is one of the dangers with trying to keep markets happy. It's like keeping a manic depressive happy. You tried? Don't. It's not going to work. What works today will not work tomorrow. What you think is this, and I think that's the problem with much of what I see as value enhancement is really price enhancement. We say, what does the market want? Let's give them what they want. And if what they want is not good for your company, eventually it's going to come back and bite you. So I'm going to focus on what so I don't know what will make markets happy. Markets are crazy. It's not my job to make them happy. But I can talk about what can change value, because it comes back to cash flows, growth, and cost of capital. So in fact, I'm going to take everything I know about changing value and everything I know in corporate finance and put it into these four buckets. I can either increase cash flows from existing assets, or increase the value from growth, or reduce my cost of capital, or increase the length of my growth period. So whatever I do in a restructuring has to go into one of those four places. So let's start and go through these one by one. So as I go through this, I wanted to think about the company you've just valued. You don't have to value control. Obviously, I don't want to add something else to your to-do list, but I want you to think about if you ran this company that you've just valued, that you should know fairly well by now, which of the four things that I'm going to describe is going to be the one that you would use to change the way the company is run. So let's start with value creation by increasing your cash flows from assets in place. So I've written out assets in place in a more expensive form as revenues times operating margin is operating income. Operating income net of taxes is after-tax operating income. And after-tax operating income net of reinvestment is free cash flow to the firm. So that's how we've learned free cash flow. But let's go item by item. First, cost-cutting and more efficient operations. If that's what you see as your basis for value creation, what I hear is higher margins. That's basically all it translates to. Because after you cut the costs and you run the company more efficiently, it shows up as higher margins. Higher margins increase your operating income. So maybe that's your play in this company, is you go and you cut costs and you improve margins. What I'm going to say next is going to sound silly, but I'm going to say it anyway. If you have businesses that have lost money, will continue to lose money, and will never make money for you in the future, shut them down. Don't even try to sell them, just shut them down. You're saying, why wouldn't somebody have done this already? Because we all hate to admit our mistakes. In fact, in investing, there's this well-established finding called loss aversion. You know what that is? That when you have a money-losing stock in your portfolio, you tend to close your eyes and not even look at it. It's almost like you get selective blindness. And you let it languish in your portfolio, so you hold on to losing stocks far too long. If you're a CEO and you make a big acquisition and it doesn't pay off, and it doesn't pay off, and it doesn't pay off, you know the right thing for you to do is cut the mistake off. But the action of doing that is admitting that you made the mistake. It's the argument I gave for why the Yankees could never let A-Rod go. Even though they knew early in the process, 2012, 2013, because Brian Cashman, who signed A-Rod, remained the general manager of the Yankees. It's not that he's a bad guy, but if you were the one who did the big contract, you don't want to be the guy who cuts off the contract, because that is the ultimate admission that you screwed up. So you know when this tends to happen with divesting assets that are money losers? Is when the old CEO loses his job and the new guy comes and he has no qualms about admitting to the old guy's mistakes. Oh, that was a mistake, that was a mistake, that was a mistake. Clear the whole table of all the mistakes because I want to make my own. So if you have businesses that are losing money, and it's tough to do, it's easier said than done if you were the one that made the mistake. What I'm going to say next is going to sound mildly unpatriotic, but take it for whatever it's worth. I have never felt it should be the objective of any company to maximize taxes paid to the government. So if you can find a legal way, notice I said legal, so I don't want this to be played back at me and saying he suggested we break the law. If you can find a legal way to minimize taxes paid, do it. It's your job when you run a company to reduce that. And there are ways that companies have become really adept at doing this, right? Moving income to lower tax locales. You don't even need to start businesses there. You essentially, this is an entire body of work called transfer pricing, where the entire objective becomes moving income from high tax locale to low tax locales. I've never been a great fan of risk management. One of the pluses you get from risk management and smoothing out your earnings is especially you have spikes in the tax rate. Like in the early 80s, the US had the supernormal profit tax designed specifically to tax oil companies, which were making a lot of money then. And that cut in at, I think, 4 billion or 5 billion. If you could keep your income smoothed out below 4 billion, you reduces your tax. So again, by reducing taxes, you increase your after-tax operating income, increase your cash flows. If you've overinvested in the past, live off the fat for a while. There's no law that says you have to do CapEx year after year after year if you're at 300% of capacity. Let the old depreciation continue. Stop the CapEx, not permanently, but for the next 3 or 5 years. You can get cash flows from it. And finally, if you have a lot of working capital as a company, managing that working capital can do wonders for you. I still remember about 5 years ago, 7 years ago, I get a call from somebody saying, can you come in and speak at a conference? I said, what's a conference on? They said, it's on supply chains. And I said, what the hell is a supply chain? They describe, I get it. So basically, you're talking about minimizing your working capital needs, because if you manage the supply chain more efficiently, that's effectively what you're doing, is you're draining those cash. Basically, the cash drains are those inventory and accounts receivable along the way. So manage your working capital better, increases your free cash flow to the firm. So that's your first stop, is you're looking to see whether there's potential in your company for doing that and increasing your cash flow. So let's make this about your company. If your company is a mature company or a declining company, this is the place you're going to start, right? This is where you get the biggest potential for value creation, is by increasing cash flows from existing assets. So usually when private equity investors, I don't know how many of you were here last Wednesday when we had that panel on valuation, where we had a private equity investor, and he was very clear about who they target. He said, we don't target high growth companies, we target established, mature companies where we think we can cut costs and make this company turn around. This was their competitive advantage, and they didn't stray. They were, so you got to give them credit. That's what they did, and that's what they continue to do. So that's my first stop, is increasing cash flows from existing assets. Any questions on that? My second stop is I want to see whether I can get higher value from growth. Notice how I phrase that. Not higher growth, but higher value from growth. Because there are two ways you can get higher value from growth. One is if you have lots of good projects, you can try to reinvest more and you get a higher growth rate, right? So in the case of SABMiller, you're saying, why did you stop at 16%? Why did you go to a 40% reinvestment rate? And if you talk about reinvesting more, you can talk about either reinvesting more by taking internal projects or acquisitions. So one way to increase your growth is if you can find a way to earn more than your cost of capital, is to go in with more reinvestment and a higher growth rate. What's the other way you can get value from growth? What if you have a company where the return on capital is actually less than the cost of capital and they're doing a lot of reinvestment? What's the pathway to creating growth there? It's to cut back on reinvestment, have less growth, and your value from growth will actually be positive because you've gone for less growth. So to me, both pathways are open, and depending on the company you're looking at again, you got to decide which pathway you're going to follow. In fact, I would argue that if you think about pricing strategy, in almost every dimension as we go through, you're going to see some other functional area come into play. So when you talk about cost cutting, you're talking about production, operations management. When we talk about growth, you're going to talk about marketing, different pricing strategy. You can go for a high volume, low price strategy or a low volume, high price strategy. And those are strategies that play out as margins, returns on capital, growth rates, and value. So if you gave me two marketing strategies to assess, I'm not going to look at them strategically. I don't know enough marketing mumbo jumbo to tell you what, but I can put them into numbers and say, this strategy looks like it has a higher potential for creating value than this one. The problem, though, with pricing strategies is you can't act like you're the only player in the game, right? Basically, this is the way it usually works. Is that if I cut prices, I'll sell more. Is that true? If you cut prices and everybody else cuts prices, you will all sell less and you'll all end up with lower margins. So a lot of game theory comes into play. And if you're going down this path, you've got to think through the consequences. You can't just say, we'll just cut prices and see what happens. So let me give you some evidence on value creating growth, because one of the things that often happens when a company says we want to create value from growth is you give them a menu list. You can do this, you can do this, you can do this. So I'd like to look at some of the evidence on historically what the best ways have been of delivering growth or creating growth in terms of value creation, and what have been the worst ways of trying to go after growth. So don't take this as a final list, but this just looks at history. It's from a McKinsey study that looked at their own clients' histories going back about 40 or 50 years. And they ranked strategies from best to worst. Across the 40 or 50 years, they looked at their companies. The very best strategy in terms of creating value from growth is to come up with a new product. The way you read this table is $1 million invested in that strategy creates between $1.75 and $2 million in additional value. Good example, of course, would be, if I asked you for examples of companies that have created value from new products, it would be the classic, of course, is Apple, right? The iPad, the iPhone, an entire decade of new products that created value. You're saying, well, everybody should do this. The downside is you can point to Microsoft, which has tried to create new products and has nothing to show for it. It's a very heavily skewed strategy. When it works, it makes immense amounts of money, but a lot of people try it and it doesn't work out. But on average, historically, it's been the best way of creating value. The second best strategy is expanding an existing market, either geographically or by finding new users in an existing market. Okay? So when aspirin suddenly became the drug to treat, that you could do if you have health, that you have heart problems, all of a sudden that expanded the market. All these people who take baby aspirins every night for the rest of their lives. Or geographically, as Coca-Cola and Levi Strauss started to run into saturated markets in the US in the 1980s, what they did was they went overseas. And for both companies, it was immensely profitable, expanding an existing market. The third best strategy, and that expanding the existing market, $1 million invested creates between 0.3 and 0.75 million in additional value. So think of that like net present value. Maintaining a growing share in a growing market. Between 2011 and 2015, if you look at Apple and Samsung, neither increased their market share of the smartphone market, but because the market itself grew so much, they were able to grow with it. So if you have a growing market, again, you get this buffer that you can compete and both make money. And then you get to the two worst strategies historically in terms of trying to create value from growth. One is competing for share in a stable market. Why is that so difficult to create value in? How do you get a higher market share in a stable market? What do you generally have to do? You have to cut prices. So you get the higher growth, but you also get lower margins. And there, $1 million invested, about 20% of the time you actually lose value from this strategy. And even the upside is not that much. You end up at 0.4 million. And if you look across the strategies, based on the McKinsey studies, the worst way to grow is through acquisitions. And this kind of reinforces what we talked about in the last session. It's not impossible. A few of you sent me examples of companies that have grown through acquisitions. It's not impossible, but it's really tough to do, especially if you're acquiring publicly traded companies and paying market price plus. So when you think about growth strategy for your company, it's easy to get carried away because in a spreadsheet you can do whatever you want. But as you think about these strategies, think about history and also think about the competition. Now let's talk about lengthening the growth period. That's so easy, right? In Excel, you just take 5 and you make it 10. Again, that's a nice thing about value on spreadsheets. You can just change it. But when you think about it from a business perspective, the length of your growth period is determined by how strong your competitive advantages are and how sustainable they are, right? That's really it. So you couldn't value your company without having a sense of what your competitive advantages are. In old-time value investing, they call these moats. You know, moats around castles. Basically it says if you're in business, your job is to create moats to make it more difficult for competitors to come across. So the question I'm asking you then about your companies, what are your competitive advantages and how strong are they? And if you can't come up with any, then we have a problem. You have a problem, the company has a problem, right? Because if you can't come up with competitive advantages, you can show me mathematically that there's an excess return. But I'm going to say I can't see what's keeping it up there, so it's very quickly going to close. So let's think about if you came into a company, how you would try to find a competitive advantage if it already exists, or come up with a new one and augment it, because that's the value creation part. So again, I'm going to play the role of a corporate strategist, a role that I'm not that comfortable in, and think about potential competitive advantages. Here's the first one, brand name. We talked about the power of a brand name when we talked about Coca-Cola, right? The power of a brand name comes from the fact that you can charge a higher price for exactly the same product, which gives you huge margins, returns on capital and value. So if you have a brand name, nurture it. Because there have been histories of companies with great brand names that let them kind of fizzle away. Think of Xerox, right? At one point in time, it was such a powerful brand name that the very act of copying was called Xeroxing. Right? Polaroid, Eastman Kodak, Quaker Oats. Apple, in the late 90s, came very close to losing its entire brand name value. It's a near-death experience that they came back from. So if you have a brand name, don't take it for granted. You got to defend it against all comers and augment it. If you don't have a brand name, you should keep trying, right? Because if you can get that, it's going to give you a price. It doesn't mean it'll work, but there's no harm trying. So that's the first stop. Second is, if you can get legal protection against competition, would you like that? Well, that's what I offer you with a patent, right? With a patent, if it's enforced, you get legal protection against competition. But be careful. Sometimes governments, in return for giving you legal protection against competition, take away something even more critical. And I'll give you an example. Prior to the 1990s, phone service in the US was a regulated monopoly, just like utilities still are, right? What does that mean, regulated monopoly? You get legal protection against competition, But in return, what do I make you do? What were the phone companies required to do every year? Anytime you have a pricing change, you had to go in front of a state-appointed regulatory commission that would say, this year you get 2%. You know what they looked at? They actually compute the return on equity for a company, and you know how we talked about this in class? They actually make it explicit. They compute your return on equity, they compare to the cost of equity. If your return on equity is greater than the cost of equity, they say, look, no price increase this year. So this becomes a little game where the regulatory guys say, we're not making the cost of equity, and the regulatory authority says, no, you're already, but already you can see that in return for protection against competition, you gave away pricing power. And if that's what you get the worst of both worlds. In what sense? Well, if you're a monopoly, everybody hates you, right? You know how you get back at them? You charge them more. It makes you feel a lot better as a monopoly. You don't like me? 50% more. How do you feel now? Right? If you're a regulated monopoly, everybody hates you because you're a phone company, you get a 2% price increase. What kind of deal is that? So if you're going to get protection against competition, make sure you're not giving up that pricing advantage in return. Third, switching costs. What's switching costs? Every time you walk by a cell phone, there are tons and tons of offices all over, right? AT&T. Every day, what do you see in the front? AT&T. If you're a Verizon customer, come in and we can switch you to AT&T in 2 minutes. You want to make the cost of switching into your product as low as possible. And once you're switched in, they want to make the cost of switching out as high as possible. So 2 minutes later, you're now an AT&T employee, AT&T customer. You feel like an employee. They give you this 16-page document to sign, right? In font so small you can't even see what's written. And you sign it. It's almost like you've signed your life away. They've locked you in for 2 years, and essentially you can do nothing. And if you did something, then they'll charge you $400 for doing it. Hey, who can blame them? Otherwise, this is going to become a service that you just walk across. Verizon, AT&T, Verizon, back and forth, trying to minimize your costs. So they want to make the cost of switching into your product as low as possible, the cost of switching out as high as possible. In technology, I think about Microsoft and how it reinvented business software. When I first started using business software, you used to have WordPerfect. In the word processing, there are like 4 different word processors. In the spreadsheet, you had 4 different. Lotus was the leader, and then you had, So it was a business. Software was a business. You basically start in your garage, and you entered the business. Microsoft essentially raised the cost of entry into the business by creating Microsoft Office. Reason is, now if you wanted to come into the business, you can't just come with a good word processing program. You've got to create a spreadsheet. You have to create the entire suite. By doing that, they effectively made this a much more difficult business to enter into. Switching costs. And finally, if you have a cost advantage as a company, take advantage of it. Let me ask you a question. How does a company acquire a cost advantage? Let me give you an example. Aramco, potentially the highest market cap company in the world. By some estimates, if it were publicly traded, its value could be as high as $2 trillion. Where does Aramco's value come from? That they are endowed all of the oil reserves in the Saudi Arabian Peninsula. You know the cost of extracting the oil there is? $6 to $8. In contrast, what is Petrobras's estimated cost of developing its reserves? $80, $75, $70. You look across the world, you look at $6 versus $80, you can already see why Aramco starts with an immense advantage. And there are 2 ways you can exploit it, right? The first is you can sell oil at $12 a barrel and drive everybody else out of business. But remember, there's only so much oil under the ground. So you might want to think about that. The other is you sell oil at $40 or $45. You're still making an immense profit margin. But there are other oil companies that are barely making money at 45, and if they borrowed money, they might tip out and go out of business, and your pricing power comes back again. You have a cost advantage, and often that cost advantage can be endowed. It can be earned. I remember when Asia became a big equity market. It started as a growing. The Templeton funds had a tremendous advantage over the rest of the mutual fund industry because they'd been in Asia about 10 years earlier than everybody else. So they already had analysts in place. They had a cost advantage. And for about 5 or 6 years, they used it to get higher market share. Eventually, it faded. But if you have a cost advantage, you can exploit it by either charging a lower price than everybody else or charging the same price as everybody else and making a higher margin. So this is where corporate strategy meets valuation. So when I listen to strategy, what I'm thinking about, what are the competitive advantages, how sustainable are they, how will they show up in my excess returns, and how long will they last, because all of those affect my value. Which brings me to my cost of capital. Now, most people, when they think about cost of capital, think about changing the financing mix, right? Different, and that's fine. You can look at different debt ratios, come up with the optimal, but don't just stop there. We talked about matching debt to assets. If you've mismatched your debt to your assets, fix it. That doesn't mean paying off all your debt and replacing it with new debt. It could be using derivatives, futures, options, swaps to try to get back into sync. Because by getting back into sync, you reduce your default risk, have a lower cost of debt and a lower cost of capital. If your product or service is discretionary, see if you can make it less discretionary. I talked, just facetiously about more effective advertising. But if you think about advertising, what are they trying to do? Convince you that you cannot live without something that you're absolutely fine without. So if it works, it actually is moving something up that list saying you have to have this. Okay? Or by changing the product characteristics. 10 years ago, if I'd come in here and say, how many of you have cell phones? Most of you would have said yes, but if I said, can you live without a cell phone? I guess so. Today, if I ask you, can I take your smartphone? It's the only threat that works on my kids anymore. I'll take your smartphone away is the only thing. Everything else, I don't care. I'll be grounded for the rest of my life. Just give me my smartphone. I'll go back to my room and I'll live off my smartphone for the rest. It's become, so in terms of what does it mean? The betas for cell phone businesses have become lower simply because it's become a necessity, something you cannot live without. And finally, we have lots of fixed costs. We talked about how that pushes up beta. If you can reduce your fixed costs, either by outsourcing or by more flexible wage contracts, you in effect lowered your beta, lowered your cost of capital. So think about creative ways to lower your cost of capital that go beyond just changing your debt ratio. So let's try this out. I'm going to show you a couple of companies, and I want you to fix these companies for me. I'm going to make you CEOs and say, what would you fix in this company? The first is SAP. It's a German software company, business software company. It competes with Oracle in the business space sometimes. Okay. So I'm going to do a valuation, a traditional DCF valuation of SAP with the status quo, the existing management running them. So as I go through this description, I want you to think about what you would change about this company. So here's what the company looks like. It's a profitable company that reinvests about 57% primarily in Europe and the US. They've been very reluctant to go into Asia because they think it's too risky. They earn a pretty substantial return on capital, about 20%, and they have an expected growth rate of 11%. So that's what the existing management does. They reinvest, but they reinvest primarily in developed markets. They make a pretty hefty return on capital. They hate to borrow money. They're 99% equity, 1% debt. So even though they have the earnings and the cash flows to sustain it, they're very old-fashioned in terms of the use of debt. They don't like to use debt. And their cost of capital reflects the fact that they're almost entirely equity funded. I value the company with the existing management in place. I came up with about 106 euros per share as my estimated value per share. So with the existing management running the company, they're worth about 106 euros per share. You come in as CEO. What's the first place you're going to look for value creation? Where's the easiest place to create value? Well, before you fix the reinvestment rate, who knows what Asia looks like? You look at, well, can I borrow more money? You can do that overnight, right? So let me give you some basis for how much they can borrow. I went in and computed the cost of capital for SAP at every debt ratio. And if you remember, we did this in corporate finance. As my debt ratio goes up, my beta goes up and my cost of equity goes up. As my debt ratio goes up, my rating goes down and my cost of debt rises. And in the second to last column, you see my cost of capital, and you can see it's minimized to about 30% debt. Right now, they're at about 2% debt. They could potentially be at 30% debt. So that's ammunition you can use to say I can go to a much higher debt ratio. And if you do that, your cost of capital is going to drop to less than 8%. The second potentially is you can look at reinvesting in emerging markets, right? Now that's going to come with some cost, and the cost is going to be that You didn't have a country risk premium before, but now that you're going to riskier markets, you will get that higher reinvestment rate, but your cost of capital is also going to be higher. So I'm going to be realistic here. I'm going to move to a 30% debt ratio because that lowers my cost of capital. But I'm also going to make you reinvest more and increase your cost of capital to reflect where you're reinvesting. With those changes put in, the value that I get for SAP, with a more aggressive reinvestment policy in emerging markets and a higher debt ratio, is 126 euros per share. What's the value of control here? It's 20 euros, which is roughly 20% of 106, right? So maybe the 20% works really well. Don't jump to it with a sample of one. It would have worked okay in this case, about a 20% control premium, because you saw a couple, but it's a fairly well-run company. There's not that much you can change. Let me give you a different example. This is Blockbuster in 2004. For those of you who know the history of Blockbuster, it was created by rolling up video stores all over the country. So this was actually the publicly traded business that took over private business in the space. So they went into private. So most of you are too young to remember, but in the early 90s, you walked through, they're all over the place. You had privately run video stores. Blockbuster was created by rolling them up. It became an incredibly successful company. 97, 98, high growth company. And then it got two threats. One was the start of Netflix with, they used to actually mail you the DVDs. And the other was companies like Walmart would allow you to actually rent the biggest hit movies for $1. So Blockbuster sales started dropping off. Their stores were not working that well. But it's almost like they were working on autopilot. They kept opening 40 new stores every year. Why? Because it always opened 40 new stores. In 2005, here's how it showed up. They had a reinvestment rate of 26%. That's the new stores being opened. The return on capital on those stores was about 4%. And their cost of capital is about 6.17%. So they're opening new stores, earning well below the cost of capital, but they can't seem to stop themselves. The debt ratio is pretty high, 50% debt, 50% equity, so there's not much room for you to play there. But if you came into this company as a CEO, what's the first thing, the first order you're going to kind of convey through the ranks? What's the first thing you're going to ask people to do? Stop opening stores, right? We can talk about everything else later, but stop this nonsense. Or if you're going to open stores, find a way to earn at least the cost of capital. That's not asking for much. I'm not even asking for positive net present value. I'm just saying, take a zero net present value investment. So in the case of Blockbuster, that's all I did. I changed my reinvestment rate to a lower number, but made them earn their cost of capital on it. So maybe those 4 or 5 stores instead of 14 stores. And with those changes put in, the value that I got was $12.47 as opposed to the $5.13 I got with the status quo. I've increased the value by 150% by changing the way this company is run. What's the lesson from this? If I gave you a company that's already well managed and well run, where there is relatively little you can do to change the way, you're going to tweak the company. I give you Facebook to run. What are you going to do? Move the debt ratio to 10%? And then say, well, not much I'd have done differently. That's going to change the value in, 3, 4, 5%. Whereas if I give you a company that's badly managed and badly run, you have a lot more levers under your control. And that's what you're looking for as an investor who can change the way this company is run. So let's set the process up. I'm going to use this, therefore, as my vehicle to talk about the value of control. My value of control comes from the fact that there are two values. There's a status quo value and a value of the firm run optimally. The difference between those two values is the value of control. That's easy to have. But to do this, what do you need? You need to change the management of this company, right? So if there's zero chance that you can change the management of this company, the expected value of control becomes 0. So I could come to you at Tata Motors and say, if somebody else ran this company, it would be worth a lot more. And I say, by the way, there's no chance that you can change the way this company is run. The expected value of control becomes 0. So there are two things I need to assess the value of control. One is the probability that you can change the management. The other is, what am I going to do after I change the management? Now, this is a fuzzy number. It's tough to come up with, but I'll suggest some things you might want to look at. The first is you want to look at how many restrictions there are on takeovers. Why? Because one of the ways you can change the management is if you had a hostile acquisition of the company, you effectively change the management of the company. I'm going to look at voting rules. If you have Class A shares and Class B shares, and the incumbent managers have all of the voting shares, I'm going to say probability that I can change the way this company is run is close to 0. I'm going to look at access to funds. Why? Because to change the way a company is run, I have to go raise capital from markets to try to mount a challenge to you. And if the capital comes from banks who will listen only to the incumbent managers, I'm shut off. This used to be the way in which companies were entrenched in Latin America and Asia, and also in Europe, because to raise capital, you didn't have bond markets. You couldn't go out and issue bonds. You were stuck borrowing from banks, and banks were too caught up with the existing management to even lend you the money. And finally, it depends on the size of the company. If I told you that Microsoft is badly managed and badly run, there's not a whole lot you might be able to do because it's a $250 billion company. A $2 billion company or a $5 billion company, there might be things you can do as a company to mount a challenge to it. This, to me, is the reason at a company like Apple, even an activist investor is like a drop in the bucket. Carl Icahn tried all those things, but you have a $600 billion company. Think of how much money you will need before you can be a large enough holder to make a difference in how that company is run. So I'm going to use this expected value of control along the way, but let's talk a little bit about this probability of management changing. It is what I hear. When I hear about corporate governance, this is what I hear in the background. And this is why corporate governance matters to me in valuation. When you have good corporate governance, you're essentially saying the likelihood of management changing in this company is higher than if you have bad corporate governance. It depends on having activist investors in the market. The Carl Icahns and the Bill Ackmans of the world, you might not like them, but they're the ones who shake the boat. Without them, think of how little power. We already have relatively little power in most companies, but without activist investors, even that power will seep away. And finally, markets where hostile acquisitions are part of the game, you're more likely to see change than where that's not viewed as something that's good. Either because there are laws against it, or implicitly it becomes very difficult to do a hostile acquisition. So let's talk about estimating the probability of change. There are lots of studies in finance that have looked at, and in fact many of these studies are structured as probits. You know how a probit works? What you do is you take 50 years of data, and let's say you have thousands and thousands of companies, and you look at companies where change happened, either because the CEO was pushed out or a hostile acquisition happened. So let's say there are 2,000 companies where that's happened over the last 50 years, and 48,000 companies where it did not happen. In a probit, what you do is you put a 1 on the 2,000 companies where it happened, and a 0 on the 48,000 companies where it did not happen. And then you look for variables that you think might explain why some companies are more likely to see change than others. So it's basically you do a data search. Let me try this, let me try that, the size of the board, let me throw that in there, the age of the CEO, the percentage of shares held by insiders. And what these studies find is 4 things seem to consistently show up. First is, the worse your stock has performed in the past, both in terms of stock price and earnings, the greater the chance of change. In corporate finance, I call it the piss-off factor, which is you piss off your stockholders year after year. There's a critical mass of piss-off where stockholders say, enough is enough. Any guy approaches me, asks me my shares, I'm going to sell it to him. Second, the structure of the board seems to matter. David Yermak, who's the head of the finance department, actually one of his earliest studies was to show that smaller boards with 7, 8 members, are more likely to see change in management than you have large boards. How the board is structured, insiders versus outsiders, seems to matter. Third, ownership structure seems to matter. CEO changes are more common in companies with high institutional and low insider holding. And finally, it turns out that when you start to see change, it tends to be clustered in sectors. In other words, one steel company CEO loses his job, you start to see a bunch of them lose their jobs. So there's very much of an industry structure kick in. So those are factors historically that have mattered, but those are things that will essentially start to show up in the expected value of control. So let's see how this plays out in valuation. I'm going to give you 4 places where the expected value of control might help you in valuation. The first is if you're doing a hostile acquisition, right? But the essence of a hostile acquisition is you think you can change the way the company is run. I would assume you care about what the value of your company is with the changes put in. The second is, even if there's no hostile acquisition, I would argue that when you invest in a company, built into the market price today are both the status quo value and the optimal value. You can say, how can they both be built in? They're built in with probabilities attached to each. And I'm going to use Blockbuster to kind of illustrate this process. Third, if you have voting and non-voting shares, I'm going to give you a way in which you can use the expected value of control to try to come up with how much of a premium you'd be willing to pay for the voting shares. And finally, in private companies, there's a big difference between being offered 51% of a private company and 49% of the same private company. Because with 49%, you're a minority shareholder in the company. With 51%, you're the controlling shareholder. If I gave you 51% of the Knicks, you would pay a lot more than if I offered you 49% of the Knicks, with James Dolan remaining the 51% stockholder. That's a minority discount. So let's take each of those. Let's use Blockbuster to kind of illustrate the first two examples. The market price at the time that I did this Blockbuster valuation was $9.50. The optimal value I came up with was $12.47. Right? I'm sorry, $12.47. So if I'm doing a hostile acquisition of Blockbuster, then I can pay up to $12.47, right? What if I paid the entire $12.47? What am I then doing? So I'm planning to change the way the companies run. I'm going to do the dirty work of fixing this company, right? But if I pay the $12.47, I've paid the stockholders of Blockbuster the entire premium. So first rule is, if you're going to do a hostile acquisition and you get the optimal value, don't make it the price you pay. You want to get some of that increase in value to come to you, which means you got to pay less than $12.47 to get some of that increase. So if you're doing a hostile acquisition, I want you to do two valuations, the status quo and an optimal value. You'd like to get somewhere in the middle if you can, because that's the way you create value for your shareholders from a hostile acquisition. But as I said, even if there's no hostile acquisition, there is this built-in probability. And I'm going to use my Blockbuster numbers, even though they're my numbers, to kind of illustrate the process. I have two values, right? The $5.13 is the status quo value. The $12.47 was the optimal value. The stock price was actually $9.50 when I did this analysis. If you think about the $9.50 as a weighted average of those two numbers, and I solve for that, the probability that the market is building in that there will be change is almost 60%. That's pretty high, right? But there's a reason why it was so high. I did this right after Carl Icahn had taken a position in Blockbuster and made all this noise about change being needed. In fact, if you looked at what the price was before he showed up, which was $8.20, the probability that was implicit there was 42%. And this is why when an activist investor shows up in your stock, you're going to see a jump in the price. Not because he increases the value, but because he changes the probability that change will happen at this company. And that's what I think markets with bad corporate governance end up missing. Is if I have a market with such abysmal corporate governance that I can never change the management of the company, the price of every stock is going to be around the status quo value. There's going to be none of this premium that comes about because you think change can come about. So it'll be interesting when you sometimes see changes in corporate governance laws to see if it has an impact. All you have to do is take the market, look at the worst run companies, and if people think this is going to make a difference, here's what you should observe after the law is passed. You should see the prices of the worst run companies jump by a lot more than the price of the best run companies, because that's where change will have the biggest impact. Now let's talk about voting and non-voting shares. I don't know how many of your companies are voting and non-voting shares, but a lot of companies in the US are starting to show this phenomenon. For a long time in the US, this was off the table. You could not do this because the New York Stock Exchange would not let you list on the exchange if you had two classes of shares. Ford was grandfathered in, but they said if you have two classes of shares, we're not going to let you list. And because every US company ultimately at that point in time wanted to be at the New York Stock Exchange, companies did not have two classes of shares. Apple did not, Microsoft did not, all these growth companies. But then somewhere during the dot-com boom, people said, why do I want to be in the New York Stock Exchange? I'll be on the NASDAQ, and I can stay on the NASDAQ. And the NASDAQ decided that one of the ways it could compete and draw people away from the New York Stock Exchange was by relaxing this law. And of course, you had Google and then Facebook, and you have all these social media companies. Almost every one of them, other than Twitter, has two classes of shares, LinkedIn, Google, Facebook. So this is now a phenomenon that has come onto the US. If you are valuing a Brazilian company or many Latin American companies, this is par for the course. You have two classes of shares. This is called common and preferred, but they're voting shares and non-voting shares. So this is not uncommon. So often when you do a DCF valuation, like you did for your company, you do a DCF valuation of all of the equity, right? But some of the equity is voting shares, some are non-voting shares. You know in your head you want to give a premium to the voting shares, but you don't know how much. So let me give you one way you might consider doing it. This is an extreme scenario, but let's assume you guys own the voting shares, you have the non-voting shares in a company, right? So let's say there are 100 million voting shares, 150 million non-voting shares. Let's say this company has a status quo value of $1 billion. Now, as non-voting shareholders, you're kind of stuck with the status quo value, right? You have no control over how the company is run. So when I ask you to value the non-voting shares, here's what you're going to do. You're going to take the status quo value and divide by the 250 million shares, the total number of shares, saying, that's $4 per share. There's nothing I can do. It's the status quo value, but I have no control over how this company is run. So if I'm valuing the non-voting shares, my basis for value per share is always the status quo value. Now let's turn to the voting shares. At least in theory, what do you have the power to do? Change the way the company is run, right? So let's assume there's a $250 million increase in value that you see coming from you running the company, changing the way it's run. I told you this is extreme. Let's say the voting shareholders control that entire process of whether change will happen. When I value the voting shares, I'm going to take the $4 per share that I got as my status quo value, but I'm going to take the expected value of control and divide it just by the voting shares, saying you guys control that expected value of control, which means you're going to get a premium over the non-voting shares that reflects the expected value of control. Let's try some real numbers. This is when I valued Embraer. This is in 2004. My status quo value was $12.5 billion. I did it in nominal reais, 12.5 billion nominal reais. I revalued it with some changes put in, and I came up with 14.7 billion as my optimal value. The company had 242.5 million voting shares, about 477 million non-voting shares. So here's the first step. I value the non-voting share by taking the status quo value, 12.5 billion, and dividing by the total number of shares outstanding, voting and non-voting shares. What I got as a value per share was 17.38 reais per share for the non-voting share. Then I took the expected value of control, which is 14.7 times minus 12.5 billion, but there's only a 20% chance of control happening here, because if control changes, it's usually going to come from the top down. If I take that expected value of control, divide just by the voting shares, I get a value per share for the voting shares of $19.19 reais per share. That premium of 1.81 reflects the fact that the voting shares control the expected value of control. So let me ask you a question. If you take this approach, when will the voting shares trade at the same price as the non-voting shares? What has to be true about the company? What has to be true about the expected value of control? It has to go to zero, which can happen in one of two ways. Either your company is perfectly managed or perfectly run, or Mark Zuckerberg owns 57% of the voting shares, in which case there's no chance that change will come. So if you look at Facebook Class A and Class B shares, they actually trade at roughly the same price. But have you been noticing the shenanigans at Under Armour? They have two classes of shares, voting and not high voting and low voting shares, but they decided that they hadn't abused their shareholders enough. So Kevin Plank introduced a Class C shares, which have no voting rights at all. And Under Armour is not as fully defended as Facebook is, and there you're starting to see a difference show up between the voting and the non-voting shares that's getting to be pretty substantial. So now Under Armour is talking about retiring those shares because they say they're paying a price. If you want this process to end as investors, power is in your hands, right? What do you have to do? You have to start discounting the non-voting shares till the company gets a message of, hey, you want control that much, how much are you willing to give up for it? 30%, 40%, 50%? Because effectively, it's going to reflect the expected value of control. The example I used was a little extreme because it meant that the non-voting shares never got the benefits of control changing. And that's generally too extreme, because if the management changes, there will be a benefit that flows to them. But it's a good way of thinking about the difference between voting and non-voting shares. Any questions? Last example, let's talk about minority discount. So let's say you have a private company, in this case Kristen Candy, privately run candy company. And I've estimated two values for the company. 1.6 million is my status quo value. 2 million is the optimal value. So let's assume I offer you 51% of this company. You'll be willing to pay up to 51% of 2 million because it'll be your company, the optimal value, right? It's 1.02 million. If I offered you 49% of this very same company, remember, you don't control the company, you're going to pay 49% of the status quo value, which is 1.6 million. So a 2% difference translated into almost a 30% difference in valuations. And that's what you see called the minority discount in private company valuations. It stems again from the expected value of control. So all I'm saying is, don't think of this value of control as something that only acquirers think about. It affects all of us in all kinds of transactions. So start thinking about the status quo value and the optimal value, because it will at least give you a way of estimating what that value attached to control will be. So let's close this process by talking about how this then plays out in consulting firms. When you look at a McKinsey, a Bain, a Booz Allen, the very top of the consulting heap is what's called value consulting. So there's a lot of middle-level consulting where you come in and fix processes. Value consulting is when the top management calls you in and says, what do we need to change about this company to increase the value of the company? And usually the first question you need to ask them is, do you really want to increase the value of the company, or do you want to increase the price? But whatever the rationale, you're now talking to the very top management, which means you can charge hefty prices per hour. So that's what I call this the cream of consulting, is value consulting. So if you're going into consulting, many of you will end up doing some version of this, coming in and telling companies, playing God, saying, if you do this, this, and this, your value will go up. But because you're a consulting firm, you want to make it look like you have the secret ingredient, something it's proprietary. So almost every consulting firm concocts its own proprietary measure that they claim is the secret way of creating value. So Holt Associates, a Chicago-based firm, created something called CFROI. I'll talk a little bit about it in a moment. They said if you maximize CFROI as a company, you're going to have increased value. A company called Stern Stewart, New York-based consulting firm in the early 90s, came up with something called economic value added. If you increase EVA, your value will go up as a company. I can see why consulting firms do it. You have to make it look like you've come up with something special, and only you can compute it. But I'm going to argue that every single aspect of what you see in these proprietary measures is already in your discounted cash flow model. So CEOs love it though. They love it because this DCF sounds so messy and all these inputs. Instead, all you have to watch is the EVA. EVA last year, EVA this year, it went up, good. I've increased the value of the company. So let's talk about how these approaches try to come up with shortcuts. So here's the revolutionary EVA approach, and as I describe it, tell me whether any of the stuff that I'm saying sounds unfamiliar to you. So here's what EVA does. It computes the return on invested capital in a company and the cost of capital in a company. And it takes the difference. So basically it's an excess return. It multiplies that excess return by the capital invested in the company. So if you have $1 billion in capital and your excess return is 2%, 2% of $1 billion is 20 million, that becomes your EVA. It's a dollar measure of excess returns. So here's the advice. You want that number to be bigger. There are two ways you can make it bigger. One is you can increase the spread over the cost of capital. The other is you increase the capital in place. This is genius. Because it told CEOs, this DCF stuff, you don't need it. Just go out and increase EVA and your value will go up as a company. And by the way, this is a better way to value companies than doing the DCF, which we will see is not true. CFROI does something different. It computes an internal rate of return based on the cash flows. It does little tweaks on real cash flows as opposed to nominal, but basically it projects out cash flows, it takes a capital invested, computes an IRR. And then it says that IRR has to be greater than your cost of capital for you to create value. So you see EVA is very much in the NPV way of thinking about capital budgeting. CFROI is more like an IRR way of thinking about capital budgeting. And they both tell you the same thing. You need to earn more than your cost of capital to create value. Just to show you that the bottom line is the same no matter which of these approaches you use. I'm going to take the EVA approach, which is an excess return approach. Because there are these valuation people who claim to use excess return models. And I'm going to show that when you use an excess return approach to value a company, you're doing exactly the same thing as I'm doing in a discounted cash flow valuation. So I'm going to keep this example very simple. Let's say you have a company which has a book value of capital of 100 million. Think of that as the invested capital used in your return on invested capital calculation. It's expected to earn a return on capital of 15% on this book value in perpetuity with a cost of capital of 10%. So it's earning a 5% spread each year. The company is expected to make additional investments of 10 million at the beginning of each year for the next 5 years. And these investments are also expected to generate a 15% of return on capital in perpetuity with a 10% cost of capital. At the end of year 5, the earnings will continue to grow 5% a year, but your return on capital will be equal to your cost of capital. So the projects you take after year 5 basically earn your cost of capital. So I'm going to value this company based on excess returns, and I'll explain what this means. I'm going to start with the book value of capital as my starting point. Remember that book value of capital earns me 5 million a year every year in perpetuity. That's the excess return. The present value of 5 million a year every year in perpetuity with a 10% cost of capital is an extra 50 million. So I have a $100 million book value. I've now added 50 million to capture the present value of excess returns from existing assets. Then I take each of the investments I make for the next 5 years and I compute the excess returns in perpetuity and I discount them back to today and I add the value added. So this is just the value created from the excess returns over and above the cost of capital. The value that I get for this firm with an excess return approach is 171 million. 100 million of book value plus 71 million of additional value. Why? Because I'm earning more than my cost of capital on that additional investment. Revolutionary, right? Let me take the same company and do a DCF of this company. Very straightforward DCF. What I did was I took my free cash flow to the firm every year, which I could with a traditional DCF. I discounted, so I took my, so basically what I had to do is build up the after-tax operating income, subtract net capex. So this is more of a conventional DCF. I get my free cash flow to the firm every year. Beyond the 5th year, I have to remember that my return on capital drops my cost of capital. So remember how we compute reinvestment rates? 5% growth forever, 10% return on capital means I have to reinvest 50. So basically, I'm doing everything I would do in a normal DCF. If I take those cash flows and discount them back at the cost of capital, the value that I get from a traditional DCF is 170.85 million, which is actually exactly the value that I got with an EVA approach. So if anybody tells you I'm using an excess return model, say that's fine. Your answer should be the same as mine because implicit in a DCF is excess returns, right? We show it as growth and reinvestment. All you're doing is netting them out and computing an excess return. Mathematically, it should always give you the same answer. So I'm going to close with a story. But 10, maybe 15 years ago, at the height of its glory, EVA was being used by 350 of the 500 S&P 500 companies. The consulting fees were pouring in. So I was on a panel in Europe talking about value enhancement to European CEOs. And I had the singular misfortune of being on the panel with Bennett Stewart, who's a co-founder of Stern Stewart. A great salesperson. The guy could sell refrigerators to Eskimos. And so we were talking about value enhancement. And on the same panel was Tim Kohler, who wrote the original McKinsey book on valuation. So it's actually a high-powered panel, and I was just hanging out on the side. And each person would get up and talk about this is the way. So their audience was right there in front of them, 150 CEOs. So Tim Kohler gets up and he does a very measured presentation about here's how in McKinsey we approach value enhancement. He talked about the DCF model and how they brought it in. And Bennett Stewart got up and he held up the annual report for Coca-Cola. Remember, these were the peak days for Coca-Cola, considered at that time leading value creator. He said, do you want to be like Coca-Cola? All the 150 CEOs, yes. Coca-Cola uses EVA. It's like one of those logic classes in high school kind of thing, right? And then he says, you should use EVA too. That was his entire presentation. Pissed me off no end. So the next time we were in New York, and this time I was ready. So he actually had sent somebody high up from the organization. They did the usual props. It could be one be like Coca-Cola. It was my turn to talk, so I get up and I had a pair of new Nikes that I'd brought with me. Very, very slowly, I took my shoes off, put my Nikes on, brought a box of Wheaties, and I poured myself, what's this guy doing? Then said, can somebody point me towards a basketball hoop? I'm wearing Nikes just like Michael Jordan. I ate Wheaties just like Michael Jordan. I should be able to slam dunk a ball. I'll be quite honest, the only basketball hoop I can slam dunk on is one of those Fisher-Price ones. Now, I kept one well after my kids had grown up, so I could go out on the deck and slam dunk a few times. There's no way I can wear all the Nikes in the world. I want to eat all the Wheaties. I'm never going to be able to slam dunk a ball. The reality is adopting EVA is not what made Coca-Cola a valuable company over the previous 20 years. And I think that's the message I would like to deliver to companies. They're looking for magic bullets. They say, give me the approach and everything's going to be okay. Value creation is hard work. It doesn't happen in the CFO's office or the CEO's office. It's got to come from the bottom up. So if you want to create value, you've got to get everybody involved, the marketing guy, the production guy, because this is everybody's job. So this is not some financial engineering device, and that's hopefully the message you can take out of this session, is if I ask you to increase value of a company, you can map it out, but then you got to bring everybody on board and say, this is what you need to do, this is what you need to do, this is what you need to do, because it's the collective effort that creates a value in the company. So please remember to send that summary sheet with your numbers for your company, and I'll see you on Wednesday.